There we go. All right, welcome everyone to a special edition of our Thursday Governance and Risk Call. Today we're going to be focusing exclusively on our recent announcement for a proposed raise to the stability fee. We're going to be discussing it in detail. We'll be talking about a high-level overview about what it is. We're going to dig into some of the reasoning behind the proposal and eventually get to some implementation and governance mechanics issues. Happily, we have some heavyweights in the meeting today, so we'll go around the room and get them to introduce themselves. Stephen, do you want to kick us off? Let us know a bit about yourself.
Stephen Becker, Head of Risk at MakerDAO.
Cool. Lev, what's a bit about yourself? Hey. I think this is the first time we've seen you on camera in these meetings.
Hi. Yeah, I'm Lev. I'm working on economic research and also a bunch of other things, but everything related to that.
Cool. You have a fancy title though, right?
Yes, I am economic research lead.
There you go, a lead. Oof. All right, Greg.
Hey guys, I'm Maker's Head of Business Development.
And also, I found out recently an econ major as well, right? So you can not only tell us how business works, but also money. So that's going to be handy. Rune, do you want to introduce yourself?
Hey everyone, I'm Rune, and I'm the co-founder of Maker and CEO of the foundation.
Great. So we have a lot to cover today. There's an FAQ that's been posted to our subreddit, so if you want to kind of follow along with the individual sections and maybe do some research as we chat, that could be useful. But to get things started, I think that, Stephen, it'd be great if you can maybe give us a high-level overview of what the stability fee is all about and maybe dig into some details for us.
Okay, not a problem. So for all intents and purposes, a stability fee can be seen as an interest rate. And what we need to do is try and figure components of an interest rate. There are actually four aspects to it. The first one is an inflation component. I mean, if you're going to loan a certain amount of money out, the return that you need to get from it needs to cover the purchasing power that you lost through the process of inflation. So there's an inflation component. The second component is obviously with respect to who you're lending to, and that is the credit component. That's the premium that sort of covers you for the potential default of your counterparty. I'll address that in a moment because it's a bit different for us. Then there's a third one called a liquidity preference component. And that is a premium that increases with respect to the term of a loan. And once again, as far as MakerDAO is concerned, that is treated differently here. But the last one, and this is quite important to keep your eye on, is the operational component. This is the component that covers the cost of providing the service. This is what banks will have calculated and included into their general interest cost to their retail customers. And within that, you also have a policy tool, which allows you to adjust the overall mechanism to allow the integrity of your system to operate. So let me just go back to the credit component. Now, generally, the credit component would be included to cover the potential default of the person that you're loaning the money to. But in this instance, this premium actually covers the cost of MKR token holders providing insurance. If the collateral for any particular situation or any event decides not to appropriately, MKR token holders have to step up and cover the loan. So that premium is for that particular purpose. Now, the liquidity preference component does not apply to us because all loans are open-ended. So we can just discard that altogether. So the three components that we need to focus on is inflation, credit, and the operational component. And for today's meeting, I think it's the operational components with respect to how it is used as a policy tool, which is going to be very important.
Well, that's interesting. And I think that people that might not have a background in risk management could be, well, I'm talking about myself. I'm confused about the definition of a policy tool. Can you give us some examples of what other policy tools might be?
Well, the thing is, with the policy tool, you've got to think about it in terms of an instrument that, well, for us, in the context of MakerDAO, it's an instrument that MKR token holders will be able to adjust to rate in order to adjust the behavior of the participants in the system. And the reason you want to do that is to obviously sustain the integrity of your system, and in thereby, in particular to us, the stability of the stable coin.
So the policy tool can be looked at as sort of a lever to generate incentives one direction or the other.
Correct.
Interesting. So how do we identify situations where policy tools might come into effect? And maybe, do you have examples of other policy tools that we would be looking at?
Sure, but firstly, let's just have a look at, effectively why we would need one. I mean,
sure.
The underlying aspect here is why have a policy tool to begin with. And you will always need a policy tool because there are always going to be frictions in the market. Now, what do I mean by frictions? It can range from, just generally the cost of transactions all the way through to the implication of tax. There are always going to be these prohibitive components that are not going to allow everything to work continuously and perfectly as designed by folks in their mind and in their models. So a policy tool should support the governing dynamics of a system. And what I mean by that is that if you would imagine for a second that your governing dynamics in your economy are working perfectly, then what you're presuming is everything is continuous and there's no friction and everything flows appropriately. But because there are these frictions, your governing dynamics will need to be supported by another tool in the event that those frictions arise and the economy is not as robust or broad and as deep as you hope it would be. So as a combination, you would use your tool to react to the state of the economy. If the economy is mature and robust, then you probably won't need to use that tool that often. But if it is new and it still hasn't developed appropriately, then it would be important to consider a tool along with your governing dynamics. So in this instance, if you have a look at the Federal Reserve, it's a very simple concept. They use an interest rate as one of the policy tools. They also have other open market operations where they buy and sell assets in large scale. But principally, the idea is that that interest rate tool is used and is the open market committee focuses on that tool and thinks about it on a monthly basis and then reports pretty much on a monthly basis what they're going to do. And generally speaking, that tool isn't used as often as everyone thinks it should be. In our situation, we're looking at an economy where it's developing. The blockchain economy is brand new, it's developing. We have to consider what the governing dynamics look like in terms of this economy and where the stopgaps and support is required from a policy framework. So I think that sort of puts it into a nutshell.
So I think I want to talk a little bit about this stuff here, just to bring the focus towards our very specific case of what happened. Sorry, just give me a second.
So actually, while Rune is dealing with something,
sorry, I'm back again. Sorry, guys.
Okay, go ahead.
That always happens. Okay, so here's the thing. So we proposed to increase the stability fee by 2%, and we said the reason behind this is because we want to protect the pig, right? We want to protect we want to adjust the market price of DAI towards the target price. And the very basic logic of that, and so this is like a policy decision that sort of is based on that fundamental logic of if you increase the stability fee, you can use that to push the prices up. And this is a part I always love talking about. I have been writing all over Reddit these couple of days, right? And it's a pretty everything in finance and monetary economics or whatever. It's pretty basic, but also insanely advanced, right? But basically the idea is that it's supply and demand kind of. So if you increase the cost to borrow, less people are going to borrow because they're going to move elsewhere to borrow from other places instead of borrowing from CDPs, for instance. And that reduces the, like theoretically that reduces the supply, right? At least it like has some negative effect on supply over time, because a percentage of the people who would be borrowing from Maker would be borrowing somewhere else instead. And the reason why we and then that reduced supply, and then we got supply and demand microeconomics of how if you reduce supply, and you keep demand steady, you can increase the price. Or in our case, it's more about it's about reducing the growth of supply relative to the growth of demand. Because what's been going on, and this is kind of what we already published, is first of all, there's been this small instability in the market price of DAI that people can actually look if they go on coin market. I mean, it's very slight, but there's this slight downward bias on the open markets. And what we found out by looking into this is that basically behind the scenes for the big market makers operating in the space, there's been this build-up of DAI over time as basically more people generated DAI with CDPs than people bought DAI in the open market to hold it. So it's actually there is this general build-up of DAI inventory by people who don't actually want to hold DAI. They just want to buy and sell it. And eventually, if their inventory keeps building, eventually that will have a very direct effect on the prices in the market, because they would potentially unload inventory or just stop buying it entirely. And so what we're basically saying is that we want to reverse this trend, and we want to change the trend so that we still want the DAI supply to grow, but we want it to grow slower than the amount of people holding DAI, right? We want supply to grow slower than demand going forward. And
one of the things I wanted to jump in here and just ask a question. So we're talking about arbitrageurs sort of smoothing out the market, creating some more efficiency for us, and how that hasn't been happening due to a glut, I guess, with CDP creation with cheap debt. What I'm kind of curious about is why haven't we seen a behavior where CDP owners are taking advantage of cheap DAI in order to pay down debts? Is that a failure of incentive?
No, so I think we have the thing, what people don't realize is we have seen this, and it happens all the time, and there are people out there doing that right now. It's just because people are doing because markets are not perfect, right? There are people out there following these incentives, but they are not massively capitalized. It's the people doing this are still a relatively small pool of people compared to the size of the overall ecosystem, which itself is also really small, and that just amplifies the inefficiencies you see because the system as a whole has a small size.
Could part of the problem be that the incentive with the 5% governance fee previously, there just wasn't enough of a drive for people to seek out the deal on DAI, and that with a higher stability fee, that incentive will be greater? Is that part of the mechanism as well?
Well, I mean, I guess the main thing is really that too many people we have been, the CDP system has been lending out money too cheaply for too long. And as a result, there's been an imbalance of people borrowing DAI from the system and then people buying DAI from those who are sort of the market makers in between the borrowers and the holders. And we want to we don't want people to close the CDPs or reverse the trend of growth in the DAI supply, but we want to slow down the growth of the DAI supply over time and bring it in line with the growth of DAI demand over time, or ideally slightly below, right? So over time, the growth in both things can sort of catch up with each other. And yeah, I mean, basically, this was communicated. It wasn't communicated very well. I mean, it was it was too late. We kind of came out and said that we have this this build-up of this imbalance in the economy. But we are completely doing, what we're doing is just we're following what the plan is to do in this situation, because you can never have, it's never possible for someone to set an interest rate or stability fee at some fixed value and just be that's it. That's what people want. Because the the reason why we are seeing too much growth in the supply of DAI relative to the growth in the supply in the demand for DAI is that people are moving their loans from elsewhere over to Maker because we're cheaper than those other places, right? So like, it's the low rates are like helping people from when they make a decision, they go with CDPs, and it's just been too good a deal basically. So like, too many people have been making that decision, and at the same time, if you look at the incentives for holding DAI, there's less people who like move from their bank account over to DAI, and maybe because in their bank account they can actually get an interest rate, for instance, right? Like, or they can. There's some other like it's more, you know, like DAI itself is still not like it has a lot of it has a significant like chicken and egg problem that of course we in the foundation are working very hard to solve, and we have these like extremely cool things coming out, such as Tradeshift Cash, and a new type of financial product that fundamentally runs on DAI and means that you have to have DAI in order to use. But before we get to that point, we just have to like stabilize what's going on right now. And yeah, and in effect, basically the stability fee increase really has been long overdue, and just mainly the negative reaction comes from like the lack of expectations set on suddenly it's just coming, right? Like we didn't discuss it beforehand. And then also because of that, it feels like it's a big increase. When really, from our point of view, it's more like the original stability fee was just very, like, it's not that we want to, yeah, you know, right? We just consider the original stability fee to be very low, like a big mispricing in a sense. That needs to be corrected to something more normal. And then from there, we can evaluate. All
right, that's a good recap. I think I made a horrible faux pas at the beginning of the meeting. I introduced everybody except for Jess. Sorry, Jess.
Oh, no, no problem.
Introduce yourself and
yeah,
talk about how you're going to be reading out the chats.
No problem at all. So I can go ahead and help articulate some of the questions that have been asked in the chat, and I can actually go ahead and do that right now. So Rune, you've basically been summarizing an answer to this, but Jordan Crandall asked about 8 minutes ago, how significant is the risk of lost liquidity from increasing the stability fee compared with the risk of slipping from the peg? So if we want to give a
Yeah, sorry, so can you repeat that?
So how significant is the risk of lost liquidity from increasing the stability fee compared to the risk of slipping from the peg?
So okay, I understand this as asking, are we going to lose liquidity from is increasing stability fee going to, yeah. I mean, well, anyway, so the low liquidity right now does not in any way come from, like, liquidity is not constrained on the supply side, it's constrained on the demand. So like, it doesn't matter because all the market makers have a ton of DAI anyway. So they don't care about being able to use CDPs right now because they already have all the DAI they need. So like increasing the stability fee for them means nothing. What it does mean is that they actually, like, they don't have to buy as much DAI anymore going forward because there will be less people generating DAI potentially. And maybe they can also sell some of that DAI to people who go to closer CDP positions. And in general, what we're hoping is this will change like expectations in the marketplace and basically increase faith in the one USD target price. And as a result, that should be something that increases liquidity. Because definitely one thing is for sure is that sort of uncertainty around where the DAI price is going in the future and whether there's a chance it could like slip away from the peg for a while, they could like suffer some weaknesses. Like having any kind of uncertainty like that significantly reduces how comfortable market makers are in creating liquidity. So this is this is definitely something that can be like fully justified as a measure to increase liquidity in the system, and something that we fully believe will have a direct impact in terms of how deep and how liquid DAI will trade.
Right. Additionally, David asked, will a DAI USD pair help? Would that make arbitrage more efficient, and would it empower some of the incentives that we were talking about before?
I mean, I'm happy to answer that. I think, can you guys hear me okay, by the way?
Yeah.
Okay, great. I would say that, so I think DAI USD pairs, and in particular DAI USD pairs that users can access. So, you know, because USD pairs require fiat banking infrastructure. There's no such thing as a DAI USD pair that everyone can access, because it'll be depending on the terms of a centralized exchange and in which geography it's available and who is eligible to open such accounts and use them and so on. Unlike decentralized exchanges, the beauty of which is that they're kind of inherently accessible to everyone. The nice thing about a DAI USD pair that a user can access is that absolutely it is a really good venue for users to find liquidity on both sides, especially when they're coming from fiat in the first place. The lower volatility in the non-existent volatility in the DAI USD pair will mean that market makers find it much easier to provide liquidity there without taking on price risk. When market makers are offering DAI against Ether or against other crypto assets, they're taking on additional risk, the risk of the asset that they're trading DAI against, not just the kind of conventional, not just the basic market making risk, which means that the spreads on a DAI USD pair are lower, which is why it's great to see DAI USD pairs that users can access, and hopefully we'll see more in the future. However, it doesn't ultimately address like systemic supply demand imbalance problems. It's more of it resolves kind of sort of, you can think of them as market structure liquidity issues or technical liquidity issues that arise from the difficulty of making markets in on volatile pairs, more so than addressing a systematic supply and demand imbalance. Because the ETH market is fairly liquid, so ultimately if market makers were ending up with too much Ether or something like that, they could always shift that into any other asset, including USD. So in the grand scheme of things, it doesn't actually resolve a problem like that, but it does make the trading much more technically efficient, which is great for liquidity.
Lev, that's interesting. I want to jump in with another question. So you said it doesn't address the liquidity problem specifically. What does address the liquidity problem?
I would say it doesn't address a systemic supply demand problem.
Sure.
I was kind of splitting the liquidity problem into potentially multiple factors, one of which is kind of some technical challenges of providing liquidity, especially if it's on a volatile pair. And then there are also supply demand challenges to liquidity, which is that, if you kind of look at the whole population of market makers and the whole population of DAI users and the whole population of CDP users, who is holding how much in aggregate. And this is kind of what drives price over the long term. And that really has little to do with exactly which pairs are available to trade, because we can pretty much assume that anyone can go from any asset to any asset eventually. Thankfully we don't have like capital controls or of course there are some unpleasant kind of things in the crypto ecosystem, but it's not that bad that you can't assume that kind of most players can go freely between asset to asset.
So it's sort of this. So you're right. We do have this sort of like this triangle happening here, but of competing groups. But I'm wondering if there's a chicken and egg situation going on where we need to stabilize supply and demand and strengthen the peg in advance of multi-collateral DAI. And when multi-collateral DAI arrives, some of the challenges that we're facing with velocity and liquidity will probably be solved at that point. Is that fair to say?
Sorry, did you mean to say that? Are you asking if multi-collateral DAI would resolve some of these issues, or are you asking what would be different? Or, sorry, could you read?
So yeah, I think I'm trying to figure out. So we're strengthening the peg. We're creating some additional incentives to even out the supply and demand pressures that we have. But it's the demand side that is lacking at this moment. And presumably with multi-collateral DAI, when the gloves come off and we have much higher debt ceilings, we have greater adoption, we have large partners like Tradeship using DAI in their day-to-day business. Presumably the supply or the demand side will be taken care of at that point, right?
Well, yeah, I mean, it would look completely different, is what we can say. Is what, of course, as the system scales, we'll have many more users on all sides of this thing. And it's hard to say how exactly they will balance out. And I think it's very hard to make a prediction that at a certain date there will be enough. There will be so many users on this side and so many users on this side, and then it'll be balanced. It's unfortunately we'll kind of have to see, and things will will develop, I think, unexpectedly, is that you don't always know when you'll get suddenly a lot more CDP users, or when suddenly you'll get a lot of, basically, it's actually mostly, I would say, completely out of control of the Maker community. So if tomorrow some dApp came out that was really popular and that was using DAI as its main unit of account, and people were now buying DAI in order to be able to trade on it, that would be great news, because this is the sort of thing that we are here for. But that could appear, and then suddenly you will have huge demand for DAI coming from people who want to use this application, and that had nothing to do with any of our policy. So the thing that I'm trying to stress is actually that policy needs to be adjusted to suit circumstance, rather than the other way around. So there will always be these realities of how DAI is being used that will have some influence on how risk parameters have to be set. And I think this is this is, if we kind of bring up this idea of the Impossible Trinity, this is actually the sort of thing that it's saying, is that you can't independently control all three of those variables. Is that if there's some kind of exogenous force affecting the supply and demand for DAI, so for example, just some market sentiment which affects how many people want to open CDPs, or who else is lending in a similar fashion to CDP. So actually, if there exists some other, say there's a centralized exchange that's lending, that's providing margin loans to its users, that will have some effect on the DAI ecosystem, because it's another competitive player in the market, and then users, in an ideal market, should choose the one that offers the most attractive terms. All kinds of these things. So we're not in a vacuum, and I think the reality is that policy for choosing risk parameters needs to split into two components. One is collateral risk assessment, and this is something that we've discussed a lot, and we've heard a lot from Stephen, and it's coming on really well, building out a rigorous framework for that. But there's a second component to it, which is well, I don't know what you want to call it. You call it a monetary policy or something like that, or a stability policy. And this is just the idea that you need to take into account some realities of the market that aren't purely, intrinsic to the risks of your collateral portfolio, but are outside of that, and that have to do with how people are using DAI and what's going on in the ecosystem around you, which also needs to affect your choices of risk parameters. And this is exactly what we're seeing with the stability fee increase, which was not driven by a collateral risk decision that we want to. It wasn't driven by us seeing that we want to charge more for loans collateralized by ETH because we're seeing more risk in ETH than we were seeing before. It wasn't coming from that consideration. It's coming from this from the second type of consideration, which I think which is a real one.
That's interesting. Jess, there's some cool questions coming up in the chat. You want to?
Yeah, definitely. So Savant asks, everything about the stability fee increase makes sense to him, except the size of the increase. He asks why such a dramatic 5-fold increase to 2.5%, and why not a 1% point increase, or even a 0.5% increase?
Yeah, so I'll answer this because I basically talked about this before. And so it's that the reason why it appears like it's such a dramatic change is more because the initial value was very dramatically low. And the reason why it was so low was because we expect, because the initial user experience of CDPs basically was so incredibly complicated that we felt like there was we expected there would be such a serious problem with using it that we just had to set the stability fee super low to compensate. And now people are really getting more used to it. And don't worry, it's actually getting a massive upgrade and becoming much easier and stuff in the future. But even now with the current interface, right, it's just people definitely use, anyone who knows about it, they're not really being held back by the interface to for them to get their super cheap loans. So basically it's just that what we are observing is, as a result of offering super cheap loans that are just outrageously cheap because of this extra this original factor of the user experience being very harsh, and so we know for sure that we know it's caused by super cheap loans. So if we just like we can increase the loan, but it's like but if we keep it in super cheap loan land, it doesn't really matter because it'll still just be like a super ridiculously cheap loan that people will continue to use anytime they can, like for this, so it's kind of, I mean, it's that if we really expect we wouldn't possibly be able to even measure the impact of a low increase. Well, I mean, or like you would just like we expect that the impact of a very low increase may not have much of an effect because it would still be by far the cheapest type of credit people have available. And then the other thing is we just fully don't believe that it would rectify the imbalance, which is of course very hard to determine. But it's just like, I mean, remember, we don't just want a supply of DAI, like growth in the supply of DAI, to line up with growth in demand for DAI. We actually want growth of the supply of DAI to go slightly below the demand for, like, the growth in demand for DAI. So like that basically speaks to doing, like we wouldn't want this like painful process where we like every month we increase the stability fee with another 0.5%, and then people are, then people would just say we were like, it was like a trick, right, where we like convince them that it's not going to be a big change, and then we still end up at the same. Yeah, so I mean, we're going to end there anyway, no matter what. This whole thing is all about the Impossible Trinity, right? And Lev just discussed that. It's like we don't have a choice, right? There's only one. When you have a fixed exchange rate, you have no control over your monetary policy, and you just have to put it at the spot where you hold up your fixed exchange rate. And again, as we observed, there's a big imbalance in how the balance sheets of market makers look right now. So there is a need for us like significant action, and that's what we think a 2% increase represents. And although, I mean, so we're not saying it's low or high or something, but we definitely like, it could be it's too high and we have to reduce it. It could also easily be it's not enough and we have to increase it further. But it's definitely going to take us to a point where we will have a much, like, depending on the outcome of this change, it's going to give us such a nice sort of overview and understanding of what happens when we do this. And so just like to get like also to like the other thing about this whole thing is, right, like there's a risk assessment, and they're doing the risk assessment of the collateral, and we're already teaching the community and including community and how all that's going to work in the future. And this other component of the policy component is going to be the same thing. Like it's going to be all about us teaching the community and us teaching each other, kind of discussing, like, I mean, our foundation, right, and the foundation risk team, and then also getting feedback from the community, and ultimately together with the community, creating this like scientific process that we use to set up what our monetary policy looks like.
Mm-hmm.
I'd just like to add to that I would recommend thinking about rates in either in absolute terms, so like we're increasing it by 2%, or in terms relative to other rates. But usually people don't measure rates relative to themselves. So, for example, I don't think it's very meaningful to say that we've increased something by 5 times. It's a lot. You can see it a lot clearer if you compare this rate to other rates. So, like, I don't know, look at how. And I'm not just saying to do that to feel good. I'm just saying that this is how it makes sense to look at rates in a macroeconomic setting. Compare this rate to whatever you think inflation is. Compare this rate to how much U.S. Treasury bills are paying. You can compare this rate to how much you have to pay to borrow for margin on Bitfinex or something. People usually look at rates in terms of spreads, or if you're borrowing to borrowers of different creditworthiness, you look at the spread over some baseline rate. Because rates will change over time, and basically the thing that there's kind of always 2 components that govern rates, which is kind of the macro condition and then the local condition of the instrument that you're talking about. And I think this is also the right way of looking at rates here. I can answer this question from Kluge about stability fee and multi-collateral. Yeah, in fact, exactly what you're describing is, I think, the way that it makes sense. Well, this is, I was just saying, this is exactly how we should think of rates in multi-collateral DAI. When we have a whole
Lev,
portfolio
sorry to interrupt you. Can you read out the question? The transcript?
Yeah, sorry. Yeah, sorry. so Kluge asks, so in the multi-collateral world, the stability fee for each collateral would cover two things. One, collateral-specific risk, and two, holding the peg by balancing the supply and demand of DAI. How will that work in practice? Will there be a single premium that is added to all CDP types, or will the rates differ and these will be used to drive a better distribution of collateral, favoring collateral that we are underweight compared to an ideal risk-resistant portfolio? Yeah, this is a terrific question. So I think there's two components to it. One is you're asking, so technically, or maybe there's three components. Well, should we think of rates as consisting of a base rate and a spread based on the based on the risk for the collateral? And the answer to that is absolutely. I think that is exactly how we should think of rates for the reasons that I just said. That's how everyone always thinks of rates. The second question is technically how will it work in practice? Will there be a single premium that is added to all CDP types? I mean, there's also a technical question of how this is represented in the system. So does the system literally store a variable that represents the kind of base rate, and then each collateral type has a spread to put on top of that? And I think yes, that is the way that it would probably look. But certainly conceptually, that is exactly how you should think about it. And then the last question is, will the rates be used to drive a better distribution of collateral? And I think that this is a great point. I will probably leave this one for Stephen to answer because I think he will enjoy this question. But I think I would as a hint, I would say that it definitely makes sense to think of it that way.
Stephen, you want to take that one?
Well, the first point to speak to is the simple aspect of where the actual nominal level of the rate is right now. The short-term USD LIBOR curve averages out to around about 2.5%. So it is roughly a good guide of equalizing that sort of return profile with what you can get in traditional market, which then will talk to what Rune had previously said and what Lev has previously said about addressing the certain imbalances coming from cheap credit. Now, the cheap credit is cheap compared to what? And this is what Lev effectively mentioned right now. You have to decide what it is cheap compared to. Now, the simplest thing in the world is, considering we are pegged to the dollar, go have a look at the USD LIBOR short-term curve. You come up to about 2.83% up to 1 year, averages around about 2.4 to 2.5. So it's just an equalization over there. And it helps very clearly understanding that point of view. Now, with respect to the question about collateral, it's actually interesting. The aspect you got to think about here is twofold. One is almost looking at the collateral and the portfolio as if you're building a big investment portfolio, and you're building a big investment portfolio in order to do one thing, that is to protect the system. So you've got a collateral point of view and you've got a specific collateral type point of view. And those types that you include into the system will have, as mentioned, a base rate that firstly looks after purchasing power and the operational component that I spoke of in the beginning. But then the third component will be very specific to that token, and it will be with respect to the volatility included into its risk profile, the underlying qualitative assessment of that particular token as well. So there is that aspect where you say we need to be compensated for the inclusion of that particular token into the collateral portfolio. But at the same time, if you think about it from an investment point of view, one generally has a look at the token or the investment in terms of the collateral portfolio as well. And what we're looking for is obviously something that has a decent change in correlation so that you have more orthogonality than you do similarities. And by including that, you will increase the diversification benefit of your collateral portfolio. Now, there is two dynamics here. The one is use your portfolio to look after the system. The other dynamic is how do you induce folks to use more or less of a particular collateral? So those aspects first have to be addressed from a risk point of view. But to try and specify how one particular collateral type should be induced over another is a constraining factor on how you build your collateral portfolio overall. It can be considered, can be done. It just is a high level of complication. I don't know if that's answered your question directly, but I think I've sort of given a sense of how you actually look at this from a high level all the way down to the the specific collateral type as well. This goes to another very important point that Lev brought up, and that is the supply and demand imbalance. That occurs naturally through the ebbs and flows of the economy. You observe it because of extraneous factors that come in, affect it, things change, and you have to react to it appropriately. Now, there's two aspects that we rely on. The first one, and this might actually talk to some other questions I've seen in the chat. The first one is governing dynamics should kick in. Your arbitrage process should kick in. But the remaining question is, what percentage difference from the peg would you expect all these governing dynamics to kick in? And that's where you actually need a policy tool to augment or rather support those governing dynamics. Because if you're asking CDP holders to realize arbitrage, at what level will they do that? Will they do that when the peg, when the cost of DAI is around 97 cents to the dollar, implying a potential 3% arbitrage profit? Well, you don't know, because the factors underlying that, the volatility of the collateral that they place versus the friction and the transactional cost of doing this. But that, in essence, is what you rely on, that governing dynamic. And if that governing dynamic proves to create too much of a marginal difference that is material to the actual peg, you need a policy instrument to come in and actually address it appropriately. And the first step, just to go back to the initial point, is the way that you create a policy instrument to be more reflective of what is a good benchmarked interest rate is by merely looking at the costing structure surrounding the thing you're pegging against, which is the dollar. So therefore, the USD LIBOR curve would be a good reference point. You can use anything else. You can use inflation. You can use constructs that you see on the blockchain. But considering the fact that we are effectively borrowing a monetary policy from the US by pegging, it may be a very good first port of call.
Cool. Thanks for that, Stephen. I think Ashley asked a question in one of our previous meetings that we didn't get a chance to address, and she asked it again. I love this question. I'd love to hear it. Ashley, do you want to ask for it?
Yeah, sure. So the question was just, can you guys hear me okay?
Yep.
Okay, great. The question was just basically, after multi-collateral DAI launches, would we be able to create different kinds of CDPs for the same asset type that have different collateralization ratios and stability fees, so that users can have different options? For example, one each CDP type that would require, say a 500% collateralization ratio and have a 0.5% interest rate, while another each CDP type could have, 100% collateralization ratio and a 5% interest rate. Obviously, I'm just throwing out numbers, but can you kind of achieve the same thing by offering a variety of options based on, the risk level and the collateralization rate?
Are we talking about the token specifically, or are we addressing the risk profiles of users? Because, if you've got like seriously risk-averse people, they want risk profiles that, tend to their incentives, all the way to, risk-loving, and, those guys will want some serious CDPs that have a higher probability of being liquidated. Is that more what we're addressing?
I'm more just talking about the ability to have, two different types of CDP on the same asset class that kind of, because I can sort of see the issue, right? Like to the question that was asked before about, is there going to be a single premium added to all CDP types? Like if you have options where, 500% collateralization ratio, you have tons of ETH lying around and you just want some, cheap debt liquidity that's very, secure and safe, then can we offer those types of options, and will that help us sort of de-risk the system, but while still offering liquidity to people that need it at a lower interest rate?
This is a consumer surplus argument. Basically, it really is a case of saying, what do the consumers want in this space? At the moment, I believe we are addressing, a certain aspect, and if we then granularize that aspect, then we definitely will be able to capture a lot more of the consumer surplus by saying, sure, you can have. Let's have a look at ETH as a example. And obviously, Lev and Rune, you can please correct me if I'm wrong from a technical standpoint. You can offer a CDP that has extraordinarily low liquidation ratio, right? Which basically induces people to take on risk, all the way up to one that has a very high liquidation ratio, which basically gives you a sense of your CDP is very safe. Now that range creates like a surface of possibilities, because it attends to not only the risk profile, but the utility function of each user. And as a consequence, by implicitly using a CDP on that surface, you've created an optimal structure for yourself. But that is very much in the hands of the users. The ability to provide this, I don't think is terribly difficult. But in terms of understanding the flexibility around this, probably will require a certain amount of time. So the short answer is sure. I don't think that's a problem. The medium term answer is I think that's going to need a sort of a learning process before you could actually offer that. Because, if you offer something that has certainly high risk in it and someone isn't aware of it, or someone is not aware of the fact that they're actually selecting one specific for a risk-loving, incentivized user, you might have an asymmetry in information which may prove a dislocative function, and you might have problems effectively.
Yeah, I think the only thing I'd add to that is that from a technical point of view, it's completely possible, and it's one of the features that the system has. I would say the only difficult thing about it is understanding user needs to make sure that this is deployed in a way that is that addresses them well. But I think thankfully, because this is a community-driven project where the users are actively participating in governing the system, I expect that the feedback there will be very direct, and it will be actually very easy to determine what what spectrum of CDP types are required to meet different use cases. I don't imagine that there will be, I don't imagine that we would have to add like thousands of different CDP types, because we don't know what users need. I think that there will probably be a dialogue where we can get a very good idea.
Lev, while we have you, there's a question that I wanted to address before the end of the meeting. This might be a bit of a curveball for you, but there was some questions in the initial Reddit thread about how this stability fee, this dynamic balancing mechanism that we've been proposing, how that syncs up with the mechanisms that were meant to be addressed by the TRFM. And I'm wondering if you can just maybe compare and contrast those two solutions for us.
Yeah, okay, I can talk about that. I think this is a very involved question, so this answer could go on for hours, but the crucial points are these. So the goal of adjusting risk parameters, such as the stability fee, is the same as the goal of TRFM was. So these things are trying to solve basically the same problem. And I would say that this perspective of adjusting risk parameters rather than using the TRFM to adjust target price is just a different is a different kind of technical way of tackling the same problem. So these are undeniably these things are closely related. I can comment on what are the main issues that jump out if you consider the TRFM, and which are not which we want to avoid with what we do. So one serious issue I think with TRFM is a usability issue. It's not really a technical issue, or in some ideal market it wouldn't even be an economics issue, but it's a usability issue, which is that when you adjust the target price of both of debt that people are taking on, and also of a currency unit that people are actively using in an economy which is still denominated. People are mostly thinking in a local currency or the US dollar or wherever they are. Adjusting the value of that unit of account as a stability mechanism is very confusing. So it would create a lot of difficulties from almost all whatever dApps that use DAI, every use case, every partner that we have, every user would find this to be an inconvenience if they had to keep track of what is the DAI to USD target price that they always need to convert things. I mean, just imagine, for example, if one of the things that we really believe in is people using DAI as a quote token on decentralized exchanges, because we think that decentralized exchanges are great, and then one of the main thing that they're missing is being able to trade against trade against a stable unit of account, which is what we're creating. Imagine what it would be like if there was all these centralized exchanges that you could trade against DAI, but DAI was like 1.02 dollars, and then all the rates were off. So when you were comparing in a different window, you were looking at what was going on at GDAX or something, it would all be slightly off, and you'll have to have a calculator out to do all these conversions. It's obviously creates a lot of friction. And not to mention a bunch of other applications where this is obviously a problem. So, and then also for people who are borrowing, it's the same effect. So we don't want to do this thing anymore where we change the value of a token as a way of creating interest, because it's just technically so confusing that you wouldn't really blame anyone for finding that to be a problem. The second thing about TRFM that is potentially problematic is that, or at least is how it was described or understood, even though I don't think this is like an inherent problem to the idea, is having this very simple feed reliant mechanism for adjusting the target rate. So if you don't remember, target rate is the rate at which the target price changes. Having this very simple mechanism for continuously adjusting the target rate algorithmically has some obvious kind of I would say stability issues if the quality of the data that's coming in isn't sufficiently high. So this TRFM mechanism is running based on a feed for a DAI USD price, and it was never completely cleared up where would this feed be coming from, how exactly would we be measuring this. And it turns out that actually TRFM is very sensitive to exactly how this price is calculated. So I mean, just to give you a comparison, another place where we use feeds is to assess safety of CDPs, right? So we use feeds for ETUSD and in the future for any other collateral to check whether a CDP is safe. One nice thing about that is that the stability of the system is not finely dependent on how that feed is calculated. So we know that provided the feed is giving you approximately something correct, something that was correct maybe 20 minutes ago, some average pulled over a large number of exchanges, the system is going to work okay, because that's going to be a decent enough expression for the price to decide whether or not a CDP is safe, right? So there's no way of like by very slightly manipulating the price that's fed in for collateral feeds, there's no way of exploiting the system or making it unstable, because that price just needs to be approximately correct. It's much more of a kind of a grenade than a gun type thing. So it needs to just basically be somewhere in the radius of the right price. While the price feed that you'd feed into TRFM, if you were using TRFM, actually needs to have very nice properties. And if it's, potentially if it's manipulated very slightly, or if it's calculated in the wrong way, there could be vectors of instability there, theoretically. That I think it takes some time to explain, but if you think about it, you can actually see why, because you'll see that this target rate is has to go either up or down all the time. And then if you kind of just get it to go up 51 times out of 100 instead of 50 times out of 100 by manipulating the price a little bit, you can drive the whole thing out of line over a long period of time. These types of things. That's not the only example, but there's this kind of thing, which means that we have to think more deeply about how to set rates than using a very simple formula like the TRFM ones. But fundamentally, I very much believe in using this kind of approach for setting rates, and this is exactly what we're researching at the moment.
That's excellent. Thanks for clearing that up for us. No, it answered some of my questions. I've always had some concerns about the sort of a volatility feedback, kind of losing control in the TRF model. But I have to admit that I only vaguely understand it in the first place. Jess, do we have any additional questions in the chat that we should address before we're out of time? Did we lose Jess? Okay.
You're mute this one.
While we're waiting,
Yeah, Yeah, we have some very interesting questions that were sort of asked and answered within the chat, but we could go ahead and speak about them nevertheless. So
Well,
one of the
that's something I would like to add, if unless like, I mean, are you talking about these questions I already answered in the chat, or is there something else?
yeah.
Okay, let's answer the other questions, and then I just have one last little comment.
Yeah, if there's nothing new, we should probably have some final thoughts, I think. So, Rune, if you wanted to sort of wrap things up, or if there's anything that we didn't address today that you'd like to talk about, that'd be great.
Yeah. Okay. So I just think like the big takeaway for the community from this meeting is mainly what Lev was just talking about in terms of how we have this like when the price feeds and the collateral, manipulating the collateral costs and like and sort of everything that has to do with the individual collateral side of how Maker is governed is very rough and like very like it just has to sort of work, and it actually, and then it will work well. But when it comes to the policy component, it's like hypersensitive. I guess we don't really know how much it is, but it's definitely like where, you know, the more precise and perfectly we set the interest rates, potentially the more liquidity we get. I think it probably, like, I mean, it's probably some like where once you get it close enough, you actually pretty much hit this theoretical maximum. But there's definitely it's going to take a long time to get to that point, and our goal is to make it like an iterative process where we, together with the community, basically try to sit down and like solve this problem scientifically as like a group of people over the next couple of years. And step one, and like the status quo of what we're doing right now, is like we are making these like big changes that are coming out of the risk team, and you know, we basically make them, and we, you know, we make some research first, decide that they're needed, we propose them, we vote them in, they come through, we analyze the result of them, and then we either do nothing or we do another change. And that's actually how, like, I mean, that's how the TRF, well, like anything like this actually really works, right? Like how the system fundamentally needs to be governed. Just like, it's just like if we can do it in higher speed and at more precision, it directly improves the power of the system. So that's going to be something that's really interesting, where like having community members involved here and having, like, I mean, being really good at this will have a direct impact on liquidity in the long run.
Okay, great. Thanks for that, Rune. Lev, Stephen, were there any final thoughts you guys wanted to leave us with? I know I'm putting you on the spot. Feel free to say no.
No.
Okay, that's great. We had some amazing conversations today, and happily, there's even more cool things happening in our chat. So if there's discussions that we didn't get to, or interesting ideas that were raised that we didn't talk about, please feel free to take them over to Reddit or bring them into our Rocket chat, and we can continue the conversation. Thanks everybody for joining us. Rune, Lev, Greg, Stephen, that was amazing. I'll be posting this on our YouTube soon, and I'll put a link to it in our subreddit as well, so people can get caught up.
Thank you, Rich, and thank you, Jessica. Much appreciated.
Thank you, guys.
All right.
See ya.
Thanks.
Hey guys, have a good day.